Today we're going to review Chapter 11, which is Financial Intermediation. So, apologize in advance. Chapter 11 is mostly theory, and so we'll be talking a lot with not a ton of examples to kind of back it up. There's a lot of definitions, just a lot of concepts, so I'll try and keep it as light as possible, but it is a little on the theoretical side. So, what is financial intermediation, or a financial intermediary? And this is your first test question. But if you look at the second bullet, a financial intermediary is an entity that acts as the middleman between two parties in a financial transaction. And like it's pretty simple. If you look at the definition of the word intermediation, it's the act of coming between. So you sit between two people. Financial intermediation is where a financial entity sits between buyers and savers, or two sides of financial transactions. Those could be traditional banks, like PNC Bank, Dexter Credit Union, etc., investment banks, mutual funds, and pension funds. But really, you just need to know regarding financial intermediaries that it sits middleman between two parties in a financial transaction. And we're going to talk a lot about this in this chapter. One of the main goals of intermediaries is to collect information. And so like if you look at the first bullet, intermediaries investigate the financial condition of the individuals and firms who want financing to figure out what have the best investment opportunities. So as we continue to talk through the chapter, you'll see examples of this over and over and over again around kind of information. That's the theme of chapter 11. I'm going to skip down to slide 7. The reason that there is financial intermediaries and the reason they collect information is because they exist to lower cost. And by collecting information, you can lower cost. And it talks about two different types of costs here. Lending and borrowing involve both transaction costs, so the cost of actually making the physical transaction, and information costs. So the act of approving someone for a loan, as an example, has a cost associated with it. There's an underwriter who gets paid to review an application. There are people who get paid to investigate, and then transactional costs are the physical costs associated with making that financial transaction. Like wire as a prime example. If I send a wire from my PNC bank account, it costs me $25. So that is an actual transaction cost. So there are 5 roles of financial intermediaries, and kind of the rest of the chapter we kind of go through each one of the 5. So the first is pulling the resources of small savers, providing safekeeping and accounting services, supplying liquidity, providing ways to diversify risk, and collecting and processing information. And I won't go into these in great detail here because we cover each of them in a little bit more detail. Slide 9 kind of breaks it down at a summary level, and the rest of the slides walk through. So pooling savings is one of the most straightforward functions of a financial intermediary, and pooling savings is exactly what it sounds like. So in order to make large loans, financial institutions or intermediaries accept small deposits, and like from you and I, to make big loans to also you and I. So as a prime example, if I have $1,000 in my savings account and the bank wants to make a $200,000 mortgage loan to someone, it would take 200 people with $1,000 in their savings account to make that loan. So financial intermediaries, one of their prime functions is to pull the resources of many savers making small deposits in order to make large loans. And of course, obviously, in order to do this, banks have to attract a substantial number of savers and then convince you that your money is safe with them. Because you certainly, if you deposit $1,000 into a savings and you have an emergency next month, you certainly want to make sure that that money is readily available for you to take out. Which is a great segue into the next concept, which is safekeeping, payment system access, and accounting. So banks are a place for safekeeping. So traditionally, like you could take your money in gold or whatever, and you could store it in a bank. So the bank has vaults where they store cash, like physical currencies. You have access to a safety deposit box. But not only that, banks also allow access to the structured payment services. So ACH transactions, which we've talked about before, and wire transactions. So banks handle those transactions for you in a safe and kind of structured way that you couldn't otherwise do. And then next test question is on this slide. So banks also help you manage your finances. And so if you can, most of us probably don't realize that banks provide us with accounting and bookkeeping services. If you log into your bank account, wherever it may be, mine is with Chase, I kind of see a running ledger of everything that I'm spending money on and kind of up to the minute balance of what's available and what I've spent. And now banks have gotten really savvy with technology, and now you can get end of year statements that say you've spent this much on food, this much on mortgage, this much on car payments, this much on interest or credit card payments. So banks now offer a ton of accounting services that are actually built in to the most basic accounts that previously you would have had to pay additional money for. We keep talking about costs, and there are costs that are associated with the legal contracts in a financial account or financial transaction, and financial intermediaries save money by economies of scale. And I think we've talked about this in an earlier chapter, but that's your next test question is on economies of scale. So economies of scale basically says that the more of something I produce, the cheaper it is per item. So if I produce 100 cookies, it's going to cost me more per item to make than 1,000 cookies. That's the whole concept of economies of scale. So in the book, the example is that you have a lawyer who writes a financial contract for your firm, and you start using that for clients. And the more you use that, the less the cost, because you only pay that lawyer one time. So the more you can use that financial contract over and over and over again, the cheaper it is per each time you distribute that item, if you spread the cost over each time you distribute it. So that's what that means. Skipping ahead to slide 14, I won't spend a ton of time on this because we talked about liquidity, I think in chapter 2 or 3. But banks financial intermediaries also offer liquidity. And liquidity is how quickly something can be turned into cash. So banks, financial institutions, have a ton of assets on their books, and they have to be smart enough to ensure that they keep enough liquid asset, so cash, to sustain large withdrawals. And it's kind of that simple. You expect, I keep going back to this, but you put $1,000 in your savings account, you expect to be able to withdraw that money at any time. So banks have to make sure that they have enough cash on hand to be able to give you your $1,000 whenever you ask for it. Skipping ahead to slide 16 is diversifying risk, and it's the next function of financial intermediaries. So diversifying risk, and I'll go back to my example of the mortgage, where you have 200 people who each take $1,000 to make a $200,000 mortgage loan. That $200,000 mortgage loan in itself is a potentially risky transaction in the event that someone defaults, just because of the size. But it's only $1,000 from 200 people. So my $1,000 being used as a part of that financial transaction for that mortgage means that there's minimal risk, or there is the risk is diversified and it's spread across a ton of people. So and the bullet just says each depositor has a very small stake in each one of the loans. And while granted no one wants to lose $1,000, still $1,000 is a drop in the bucket when you look at a $200,000 loan. looking at slide 17, and much of your activity this week comes from this concept of collecting and processing information, and this concept of information asymmetry, and we'll break this down a bit. But information asymmetry basically means that borrowers have information that lenders don't, and financial intermediaries are constantly trying to solve the problem of information asymmetry, and they do that by collecting and processing and standardizing information. So we'll skip to 19. There are two types of asymmetric information that financial intermediaries face. One is adverse selection and the other is moral hazard. So adverse selection basically happens before a transaction or before an account is open. And it's how do lenders know what is a good loan or what is a good candidate versus a bad one. So that's the first type, is adverse selection. So it's basically how lenders filter out the candidates or the loan applicants who will default. And there's a number of ways that that can be done. Credit applications, or depending on the loans, like credit application is one of them. When you talk about insurances, they look at driving records and things like that. So the other is slightly more difficult to solve, and that's moral hazard. And that is what happens after the transaction. So how do financial institutions know that borrowers will use the money as they claim, or more broadly, act responsibly? So a moral hazard problem for an insurance company, a car insurance company, could be, after I sign you for insurance, how do I know that you're going to wear your seatbelt and you're going to drive the speed limit or not drink and drive, right? So that's moral hazard. And if you do a great job at adverse selection, then you can reduce your moral hazard. But there isn't always an element of moral hazard that will remain, just because no matter how good you screen your potential applicants, there is still an element of you really don't know what that person will do with the loan or do with the money, or do on the other side of that financial contract. And it's not just, we always generally look at the financial institution side of this equation, but even as a borrower, like as an investor, I want to buy a stock. How do I know that the company will use my money responsibly? And that's why there are requirements for publicly traded companies to file reports yearly and quarterly to show the performance of the company and how they're doing overall, where the money went. They have to provide a clean look at their accounting records. So this helps solve the problem of moral hazard, because you get a review of what that company is doing with your money. So it's there's information gathering is huge for both investors and folks on the other side, or financial participants on the other side of the transaction as well. We have a few more topics to cover. Two other ways that banks, financial institutions solve the moral hazard problem is collateral and unsecured loans. So collateral is something that you put up. And so like if we take our mortgage example, the bank loans you $200,000. How do they know that you're going to be responsible with that loan? And collateral helps solve that. So the bank, if you choose not to pay or choose not to keep the right level of insurance on your home and act responsibly, that house is collateral. The bank can foreclose on that house, basically take it back, and then they have the value of that house, which should probably be around $200,000. But that is one way that they can make sure that you act responsibly, is by saying this type of loan requires collateral. And lastly is unsecured loans, and unsecured loans are, credit cards. They are loans made without collateral, and so they have high interest rates because there is no collateral associated with them. So that is, the bank charges more for the risk that they take. And the last slide I'll review, because I only have 30 seconds, and I don't want to create another video, is slide 26. So slide 26 basically says that principal agent problem, and there's a test question on this, and the principal agent problem is because Managers of the firm are not the same as investors. So if I have stock in a company, I am not managing it, someone else is. That creates a problem of moral hazard, and it's called the principal agent problem, which is a test question. Look it up a little bit better in your book. That's chapter 11.